a record-setting pace for listings on the Toronto Real Estate Board, and terminations are more than double than we've ever seen before. What does this mean? Well, buyers, and sellers are not in alignment. And my friends, first-time homebuyers have way more options than you think. All this and more with our good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, back with our favorite mortgage broker in all of the land, Mr. Dion Beg. How you doing, my man?
I'm well, Gary. It's been a busy week, helping lots of first-time buyers. So excited to talk about that with you today.
Good stuff. We got, as Dion just said, first-time home buyers. Yes, that's been a theme over the last couple of videos, and we're going to dive deeper into some of that moving forward. But there's a few highlights that we're going to touch on today to help our first-time home buyers, and perhaps to open some doors for, and maybe open those doors to more questions down the road. But Dion, there's a few things going on in our market that keep coming up in the headlines, and one in particular is pre-construction, whether it's condos or whether it's, resale homes. And there's a lot of talk about homes just not selling. I don't know if you're kind of seeing that from some of your clients, but perhaps you are.
Yeah, I know that. I'm in a couple of situations where clients have come to me after the fact, where they've actually gone and purchased a property, and then they've tried to sell their existing family home, and it hasn't sold. So yeah, unfortunately, there's those situations out there right now.
Yeah, there's lots of stuff. I'm gonna bring up a stat on the video here from one of our agents, Matt Gizzy, and shout out to him for putting in the research. And it'll look like a lot of info, but let me just highlight.
That looks like a bowl of spaghetti.
So I like seeing stuff, but here's what Matt's saying is, and these are trends over the last several years of how many terminations we're seeing on the Toronto Real Estate Board. And what I can tell you is in our typical month of May, if we just looked at May for the last 7 or 8 years, what is the amount of terminations? And
so, sorry, Gary, for us non-realtors, what's a termination?
Exactly. Good question. Right on cue. I love it. A termination is when when the listing agent and seller choose to terminate the listing. Now, that can be for a number of different reasons. Maybe the decision to sell has changed, or in many of these cases, the marketing strategy does not align with the buyer's buying strategy. So let's talk about that a little bit, is what we're seeing. And let's talk about the number, and then we'll talk about some of the reasons why this is happening. What we're seeing on screen here is the number of terminations per month over the last several years. And I looked at the month of May, and the median number of terminations in the month of May is typically around 7,200.
So about 7,000. Okay.
We'll call it 7,000 on the entire Toronto Real Estate Board. As we said in the past, that is a massive area, largest real estate board in the world. So there's going to be, these numbers are going to be big regardless. You might think, well, 7,000, that sounds like a lot. Let me tell you, my friends, you can see, and you might be able to already see it right on the screen, but for the month of May in 2025, we had over 16,000 terminations. And for the month of June 2025, we're trending over 17,000 terminations. So what does that say?
It's like 2.5 times normal, is it?
Almost, yeah, almost that. Just two and change. That says a few things. Buyers and sellers are not in alignment with the valuation of the properties.
Yep.
It says a couple of things as well. The marketing strategy behind what's going on here in the number of these listings is not in alignment with what buyers are expecting. And remember, your home is only worth what someone's going to pay for it.
Yeah. I think a lot of sellers are probably still anchored on the fact that, my neighbor's home sold for 1.2 million. Mine must be worth 1.2 million, but the market's only willing to pay 1.1. And I'm sure, Gary, with the realtors in your network, you must be hearing the same story, right?
We're seeing the same story. We're hearing the same story. We're experiencing the same story. And I can tell you in some cases we've seen homes purchase at, we'll call it, that 1 million mark 2 years ago. Some rentals were done to that home or updates done to that home, and life changes and you put that home up for sale today and you expect, well, okay, it's probably about worth 1.2 and change maybe because of the renos and the appreciation of the home. I can tell you that same home, amongst different relists and pricing strategy adjustments, is now listed for less than what they bought it for 2 years ago. So
yeah, and I'll tell you how that translates to mortgage financing too. So we've got a lot of clients coming to us at the moment. Over the last couple of years, a lot of Canadian households have had challenges with meeting their monthly obligations. Because of that, they've run up some credit card debt or consumer debt. And what we would always want to do in scenarios like that is and by the way, those interest rates on credit card, 25, 29%, we try and get those rolled into a mortgage at 4.5%, ideally, at today's rates. And traditionally, Gary, we've always been able to do that because we've been in markets which have continued to tick up and up and up in terms of valuation. But in the last couple of months, we've had situations where even the client was surprised when we send the appraiser to the property. There were recent sales in the neighborhood that meant that their house, which they thought was worth $1 million, is now worth $900,000, and that extra $100K was the money that we were all counting on to be able to consolidate that debt. And so, if you talk to any mortgage broker in any part of the GTA right now, what they'll be telling you is one of the biggest challenges they have is appraisals coming in at the values that we need. Not so much on the purchase side, but on the refinance side.
Yeah. And we just highlight us or just kind of touch on the highlights when we're doing an appraisal for a refinance or a mortgage like this, what you're explaining there, Dion. Explain why it's not I don't want to say true market value, but it's not that resale value of what a buyer would come in and purchase. Explain why that's a big piece of it.
Yeah, ultimately, just understand that an appraiser will have to go off two big factors. One is recent market sales, okay? And let's just say we have scenarios where maybe something hasn't transacted and when I say recent is 3 months, okay? But let's say we come across a scenario where nothing has transacted for 3 months and they have to go and look at things that were like sold 5, 6, 7 months ago. They'll see those sales, but at the same time, they will look at other sales in the market, not of direct comparative properties, but the general trend for the neighborhood or the region. And if they say, okay, in the last 6 months, the general trend for all property types has been down by 6%, then what they will do is they'll just shave, say, 6% off that sale that happened 6 months ago. And so this is where, if the last reference point that you or your client has is a sale that happened 6 months ago, it doesn't mean that an appraiser can actually use that value.
Oh, those are important details, my friends. And if you need more clarity on that, reach out to Dion and myself. Okay. So all we're saying here is, not all we're saying is there's always opportunity in the market, but when you're going to list your home, make sure you're in alignment with what that data is telling you in the market. Make sure you're getting up-to-date information. You're not relying, as Dion kind of explained right off the top, you're not relying on a home that sold 4 or 5 months ago or even longer ago, and those valuations are going to be different. Definitely in this market, we're seeing more and more listings come up. Okay. First-time home buyers, and maybe this will be a little bit broader than sometimes in first-time home buyers. You're looking to purchase a new home, and there's different ways we can do that, obviously, and different ways that family members, for the sake of this content today, can help out with that. So, Dion, I got to throw up some questions here. You walk us through what's going on, and we've often talked about this as, okay, I'm a parent and I want to be able to give money to my child so they can go purchase their home. How does that look? What does that look like? Walk us through the gifted down payments.
Yep. So one of the old ways that people can help is through a gifted down payment. Sometimes this might be, $5 or $10,000. Sometimes it might be $200,000 or $500,000, depending on how much those parents are in a position to be able to help. Now, in terms of gifted down payments, just know that this is 100% acceptable for every lender that we work with. For larger gifts, we may need to prove that let's say that 200 grand was sitting inside of the possession of the parent's bank account. But for smaller gifts, say under $50,000, we don't really need to figure out where that money came from as long as we have a gift letter. Every lender has their own form of a standardized gift letter, which the parents will sign and the children will sign to say, yep, this is a gift. What's important, Gary, is also that it must be a gift. It can't be a loan from mum and dad to the children. It has to be a gift if we're putting it through the gift letter status. Now, in terms of the way that people are accessing that money, sometimes the parents are in a position where they've had a good life financially, and they might have that money just sitting in a bank account or a mutual fund which they'll cash in. So that's one option. The other way that they might do it is through a formal sort of early inheritance, where they're saying, hey, we have our will done, but we're going to give you this 200K today. It means that we're going to adjust our will so that when we sell our estate, we gave you 200 grand, but we didn't give your sister 200 grand. And so she's going to walk away with 200K in the future, more than you when we pass and when our estate is settled. So that's another thing that we've seen people do. The other thing too is the parents might have an established home equity line of credit on the home that they live in or on other property, and they might just reach in and grab that cash from the home equity line. Sometimes we actually refinance the parents. The parents say, you know what, we don't have a mortgage, but we're willing to take on a mortgage on our house and service that mortgage ourselves and gift that 100 or 200 to our children. And we've facilitated those types of loans as well. And as we've discussed more recently, Gary, we're seeing reverse mortgages used a lot for that exact same scenario where, yes, we'll go and get a mortgage on the parents' house, but they don't want a monthly associated payment with that mortgage. So they'll get the 200K, but they'll get it as a reverse mortgage, which doesn't have any monthly payments. So, yeah, there's a bunch of ways in which we're helping people access that down payment from parents.
Excellent. And the gifted down payment is important because, and as you said, and I want to highlight again, it needs to be gifted because when you go and qualify for that mortgage, you have to prove where that money came from in a sense. And that's why it's important that it's all documented, my friends. It's all documented. Okay. We've seen this and we've heard about this in the past too, is co-signing on the mortgage. What does that look like? And you've touched on it briefly there in a sense. And sometimes we need, when we go purchase a home, and sometimes it's just one of the purchasers, sometimes it's two, and in this case, it might be more.
Yeah, okay. I'll actually go with an example. As of just yesterday, I spoke to a young couple. Combined, they make $100,000. Together, they qualify for a mortgage of around $450,000, okay? Now, in talking with them, they explained that they could afford a monthly payment of around $2,500 a month, which sort of puts them in that range of, say, the $450,000, $500K purchase price. But they were hoping for a better, bigger property that would suit their needs as a family or future family, right? So when we spoke about things, we talked about this idea of, say, buying a duplex. And again, you and I have spoken about this before, but a duplex would cost them a lot more. It would cost them $800,000, so a lot more than the $450,000 that they would qualify for. But that duplex would bring in rental income from the basement unit, and they would live upstairs in a property that would be superior to the property they would buy for $450,000. Okay, now the thing is, they could afford that payment because of that rental income that the property would bring, but they would not qualify for that mortgage of $800,000 by themselves. So the conversation we had last night was, okay, well, if we were to add one parent who makes good income, then what will happen there is that income will be added to the application that we put forward to the lender. And now what was limited to a purchase of $450,000 now allows them to go and purchase for that $800,000 number, buy the superior property with, in fact, better, which will result in a net lower monthly mortgage payment because of the rent that basement apartment would bring in. So the addition of a co-signer allows us to use their income to boost your purchase price to a higher number. But we would never do that unless we knew that you could afford the associated monthly payment, because your mom and dad aren't the ones making the payment. It's you who is going to be making that payment.
Excellent. Okay. So we have gifted down payment. We got co-signing on the mortgage.
Actually, before we move on, Gary, regarding cosigner, there's a couple of points I want to say here that a lot of people misunderstand. So on the co-signing front, people ask me this question: Hey, Dion, my parents have a mortgage, so they probably can't help me get a mortgage. Okay, this is a very common question that I get asked, and 9 times out of 10, even if parents do have a mortgage, they are still able to help. Okay. And put simply, let's just say that the parents are able to qualify for a mortgage of $500,000. Their own mortgage on their own house is $200,000. Okay. What does that mean? It still means that they've got capacity of $300,000, which they could then, add to your application. So just because your parents have a mortgage, it doesn't mean that they're not able to help you. In most cases, they will be able to help you. Okay. The other question I get, Gary, is, hey, Dion, my parents are on pension, right? They're retired. They don't make a lot of money. Yeah, they own their own house, but, they're on government pension, and I don't think they'll be able to help. Okay. Again, I have to say to our prospective clients here, in fact, your parents can help. Even if their household income on paper is $30,000 a year, which was the case in one of my recent files, that $30,000 allowed an extra $120,000 mortgage qualifying for our first-time home buyer. So again, because your parents are on pension, does not mean that they can't help. In most cases, they can.
Yeah, that's good clarity. That's excellent clarity. Okay, we talked about gifted down payment and now co-signing on the mortgage. Is there a place in a world where we can do both?
Yes, and this happens quite a lot, right? So we've got parents who are just ready to help in any which way in order to get their children into the property market. And so, what they might do is they might gift $100,000, right? And at the same time, they might also co-sign. And so we've got more down payment. By the way, that extra down payment often gets us to the point where we do not need to take on lender's mortgage insurance, which means that we might save anywhere from $10,000 to $30,000 to $40,000 in mortgage insurance premium, right? So that's the benefit of that gift. And then, secondary to that, if the parents are able and willing to lend their income to the file, then yes, we can actually combine the gift and the co-signing onto one file to strengthen that file.
Yeah, no, that's an excellent point. And I know how many times regardless of where we're buying, you might be working with a buyer that has 17 or 18% down payment, and it's at that point that's when you really want to figure out how can you generate that extra few points to get to that 20%, where typically there's no no CMHC insurance or that type of thing, right? Like that's where you really want to have that conversation.
Yeah, and you know what? Sometimes when I speak to clients, they're like, "Oh, I really don't want my help from my parents, right? I really don't want the down payment gift. I'm independent. I want to be independent. I'm a grown person. I don't want to lean on my parents." And then when I explain to them, listen, here's your choice. You are either going to get an insured mortgage where ultimately you're going to borrow an extra 20 grand, which goes to an insurance company, or you borrow a little bit of money from your parents, and the money that you would have otherwise sent to the insurance company, you could potentially, work it out with your parents in some way. So I would much rather that outcome be the case than people throwing money at insurance for which they'll never see a return.
Exactly. That's a good point. Yeah. Okay. Speaking of parents, multi-generational living, we've been talking about this for the last couple of years, it feels like, Dion, and we're starting to see this become more of a trend in North America, I should say, because it happens all over the world. It doesn't happen quite regularly here in North America, or it hasn't until the last couple of years.
Yeah, look, I mean, one of the biggest complaints, and it's really a complaint, but murmuring amongst my 50-year-old clients is, I don't know how and if my children are ever going to buy their own home. Are they going to live with me forever, type of thing, right? And it does understandably create some level of, tension. Having this many grown people living in a house sometimes is challenging. Or their adult child is renting and paying $2,000 a month in rent that will disappear, and they'll never get any return on it. And so what we're seeing is people saying, look, if rather than you pay rent, or if we're going to live together in one property, maybe we should acknowledge the fact that, hey, you're making good income. You're making 80 grand a year. My daughter is making 80 grand a year. Why don't we add her to our application as a family? So now we have 3 incomes on the deal. And in doing so, we might be able to upgrade our home from a $1 million home to a $1.4 million home, which then allows us to have a fully sort of set up walkout basement, right? And rather than, live separately, we'll all live together, but we'll make sure that it's comfortable, in that the property is large enough for us to live together without interfering in each other's lives for the next 10, maybe 10 years. Gary, people are getting married much later in life. Actually, at what age did you get married? You were early, right?
Yeah, I was 23. So young
23,
compared
okay.
to today's standards.
You were ultra young. I was 28. Now, if I was to guess at what is the age at which people are getting married today, I would probably guess it's probably in the early 30s. I mean, maybe somebody listening to this can correct us. But, and that being the case, and also the marriage rate, it must be down, I'm going to guess, 50% over the last 20 years, because people just aren't coupling up and marrying and settling down in the same way that we used to. So because of all of these changing demographics and dynamics, that traditional 2 people pair up, combine financial force to buy that property, it may not happen. And so that combining of income may not come from coupling up, but it might be actually working together with your immediate family.
Yeah, and we're starting to see that trend. We've shared this in the past, Dion. A year ago, we made the move across the country from the Toronto area to the Okanagan, and there's a lot of builders here that are building brand new homes with, we call them, they call it suites here, whether it's an income suite or, in this case, multi-generational living. And it's completely separate. In fact, if you looked at the home, you'd have no idea there's a separate suite in it. Obviously, the own entrance and everything. We're just starting to hear murmurs of builders doing that around the GTA. And Dion and I have both talked about this in the past. That's going to become a bigger trend. And in fact, the home that we purchased doesn't have a secondary suite or a suite. However, with some slight modifications, renos, I love renos, it can easily be put in. And we're starting to see, I'm in my early 50s, we're starting to see that type of home buyer purchase homes specifically for that, because they're thinking ahead. Okay, yep. Last one here, Dion. Helping kids buy a rental property. You and I have both done this for many, many reasons. Let me just set this up a little bit because many, many people can't afford where they want to live, like downtown Toronto or, the whatever district that they happen to be in. They can't afford a property there, but they have, as you mentioned, great income. So we can help them purchase in the suburban areas where there's good income potential. And of course, the values, the home prices are much more attainable there. Fill in the gaps on that one, Dion.
Yep. So again, let's just say, I'll give you an example. Let's say the child is living downtown in a condo because that location suits their lifestyle, close to work, close to friends. That's where they want to be, and they're happy renting. But they don't necessarily want to buy a condominium. Let's say the parents live in the outer GTA. Let's say the parents live in Markham, okay, and they're very happy where they are. But they're a little concerned about the fact that, look, my child's making good income, but they haven't yet got their first step into the property ladder, right? And so what we've seen is, those parents in Markham coupling up with their child who's renting downtown in Toronto and saying, hey, let's go buy a rental property in Niagara. Let's go buy a rental property in Oshawa. And they might do that together with their child, right? So maybe 3 people are named on title, and they would all benefit from the potential growth on that asset over the next 10 years. And, what that does, it gives options to that child in 10 years from now, meaning, the child's lived the life they want to live. They've lived in a location, close to work, close to friends, but at the same time, they've been building equity through ownership of a piece of real estate that's not necessarily where they live.
That's it. That's it. I mean, it is a great way to take advantage of, as you said, the income that you're currently earning and put that to work into a rental property. My friends, there's lots of great opportunity in the GTA area, or right across Canada, wherever you happen to be, and reach out to Dion or myself, and we'll make sure that you're getting the answers that to the questions that you may have, because there's just simply having these conversations, Dion, it opens up opportunity, doesn't it?
Oh yeah, and oftentimes we ask the question of the client and they've never had the conversation with the family members, or they were scared on how to approach that conversation with the family member. And they're the types of conversations that we are often in, on that Zoom call with mom and dad and grandma and granddaughter, everybody all together, and we just talk things through. So yeah, always happy to help if those conversations need to be sort of facilitated.
Exactly. And you being in the previous job life, being a financial advisor, even talking to parents about their kids that are in their late teens, or it doesn't really matter their age, and just having them even start to save monthly, and what that looks like. And as you said, if people are choosing to get married much later in life, into their 30s, 10, 12, 15 years of $100 a month into your first-time homebuyers type tax-free savings account it can change people's lives in a sense, because they haven't thought about that simple step, right?
Actually, you bring up a good point, because just recently I had a situation where we had an adult child in his 20s living with his parents, and his parents had been charging him rent at, I don't know, $1,000 a month or something like that for the last several years. They didn't tell him this, but what they had been doing was they'd been saving that $1,000 a month in a separate account to give back to him when he was ready to buy, right? And so it was a surprise for him, but what they had been simultaneously doing was setting up the discipline to set aside a certain portion of income to cover shelter cost. So that transition from living with parents to living by yourself was an easier transition for him.
Yeah, I love stuff like that. Okay, my friend, how do people get a hold of you?
Yeah, you can reach us at kangamortgage.ca or Instagram at Dion Beg.
There you have it, my friends. That's Dion Beg. Of course, I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.